Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. I am joined by Mel Mattison, author, investor, and former fintech executive. Mel, you wrote to me saying that you were a fan of my show and you wanted to come on because you had done a lot of work on the history of the monetary system and the future. And you had a thesis about sort of where things are headed. What is your thesis and what do you have to say?
Really quick background on me. I've spent over 20 years working in the financial services industry, working for large established managers like Russell Investments, venture capital funded firms like United Capital, which was sold to Goldman Sachs for $750 million in 2019. I have a MBA from Duke University in finance. And during the course of these 20 years, I've also been a bit of an amateur financial historian and an active investor. And what has happened to me is I've listened and been aware for a long time about people talking, we're getting into untenable situations with debts and deficits. And I've always looked at the market for what's really going on. And I haven't really seen that distress or that loss of appetite for US Treasuries or concern by big players, whether that be the rating agencies or what have you. And I think a lot of times it's a little bit of a boy crying wolf situation where people have been predicting this, and people are saying, yeah, people have been predicting this for 20 years that, the situation's untenable. But I think that the market is now telling us that it really is, and that we're getting close to that end game. And so what I've done is I take a financial history perspective. I look at the really history of central banking, why it exists, what's been going on, going all the way back to William III, 1694, founding of the Bank of England. And I move it through today and into the Bretton Woods era. And then I kind of flip on top of that a understanding of the entitlement spending and the situation with the Social Security Trust Fund and other unfunded liabilities of the US government. And I come to the conclusion that, as was predicted by John Maynard Keynes in 1944 at Bretton Woods, that if you put the US dollar as a reserve currency, you get into the situation that many of your listeners may be aware of, Trippin's paradox or Trippin's dilemma, where the reserve currency country, essentially to feed the global economy the amount of dollars that it needs, gets itself in a perpetually untenable debt situation, and that we're reaching a crescendo, and that at some point in the next, I believe, probably 2026, 2027 timeframe, we're going to have a asset bubble crescendo and then a collapse.
You alluded to it, Mel, but I just want to say that people have been saying this for longer than I've been alive, and that at every point, that argument may have made sense. For example, people talking about the debt is unsustainable in the 1970s. In the 1970s, the US federal debt, public debt, was $350 billion. Now it's $34 trillion. What has happened to bond yields? Bond yields, have they gone up? No, they've gone down, meaning the prices have gone up. So the more debt there is, it seems the more that the private sector wants the debt, the more the rest of the world wants the debt. So, Steve Eisman, known from The Big Short, he said something I thought was very funny and true. I've said people in the investment business say, if you're early, you're wrong. I've been early by a year. I've been 2 years early. I've never been 40 years early. And if someone was saying, people have been saying this for 40 years and it hasn't happened, why now?
So I think those are great points, and they're well taken. And I think what you want to look at is, what is the market telling you? So look at certain market signs. You look at the gold price. So we're over 2,400 as we're recording this on the front month futures contract. Silver over $30. If you look at Treasury auctions, obviously in Q4 last year, we had a 5 basis point tail on a 10-year Treasury auction. We recently had a 3 basis point tail this quarter. And, just for your listeners, that's when basically the bid to cover is coming in under the market price. And so that in as liquid and as big and as large as a market as the treasuries, even a 3, 4, 5 basis point tail is a significant event.
And has that happened before? I mean, yeah, is that completely new?
Well, some of these things have happened before. So if you look at when we went off the gold standard in 1971, what happened to the gold price over the next 10 years? It went up 25 times. It went from $35 an ounce to $875 an ounce in essentially a 10-year period. So just imagine if you use a baseline of say 2000 and then you put a 25 times multiple on that, you're at a $50,000 gold price. Now, I'm not saying gold's going to $50,000 anytime soon, but I do think that, and other people have talked about this before, there have been two times when the Dow equaled the gold price. One of them was in the Great Depression when the Dow traded down to, I believe, about 36, and the gold price at that time was 35. And then in the 1980s, we had gold at 875 and the Dow was in that neck of the woods. Now you look at the Dow right now, it's hitting 40,000. If we were to get gold and Dow parity again, that's going to require either a very significant rise in the gold price or a very big fall in the Dow. And I think, both of those things are very possible within the next 4 years, where we could see a 25, 30,000 Dow, a big drop, and a $25,000 gold price, which is absolutely, ridiculous. I understand the ridiculousness of that. But if we are truly entering into a new monetary regime and we're going to have this switch where the dollar denominated, status quo gets changed, then I think these types of things are possible. And what I really worry about and what I'm concerned about is a lot of people, whether it's Larry Fink or Warren Buffett or all these top investors, they're preaching to everyone, all Americans, that the path to prosperity is to invest into the stock market. And while that has been true post World War II, I think it's important for investors to recognize that long periods of time with no real gains in an equity index are possible. And just two examples: 1933, it took 25 years to get back positive. And then you look at Japan, 1989 until just earlier this year, a 34-year period. And so I think at the same time, we're getting these important, influential voices telling people, put your money in the stock market. As long as you're long term, you're going to do well. That we're actually could possibly be entering a period of what I believe is going to be a crescendo, a bubble, the likes of which we probably haven't seen since 1999, and then a collapse. And I believe it could be a decade plus period before we get back to those highs.
A few things, Mel. First of all, I want to say that I personally am inclined to disagree with you. Of course, yeah, there have been multiple decades periods where stocks have done nothing, and many periods of drawdowns of in the Great Depression, 80%. I don't know, maybe close to 90%. But you can say the same of gold. Like from 1981 to 1999, the drawdown from gold was immense as the stock market crushed it. But Mel, the fact that I personally am inclined to disagree with you, I don't really care that much that I disagree with you because it's all about your thought process. And, I know you've read 200 books on financial history. You've thought about this a lot. You've written a book called QUOZ, QUOZ, about a financial thriller about quantum AI, corrupt central bankers, and the blockchain collide in a stock market supernova. I know you've done a lot of work on this, Mel. And so I know your thought process about why you think what you believe about there being a giant debt bubble that will ultimately be very good for gold and quite bad for the stock market, although and it sounds like in the short term you think there will be a stock market supernova. I know that your reasoning is very complex. You've done a lot of work on it and it is much more sophisticated than, oh, the Dow and gold have been at the level twice.
Hmm.
With
Hmm.
respect, like you're better than that. And
Yeah.
one thing that I really really don't like is when people post charts about commodities to stock indices and they say, "Oh, in 1915, the commodities to the Dow was such and such, and now it's so low." It makes sense why over time stocks will crush commodities because Stocks have earnings, and those earnings invest to make earnings bigger in the future. The economy grows. They can do dividends. They can do buybacks. Meanwhile, a bushel of wheat does absolutely nothing. So it makes time. Like I'm long term. On a century plus basis, stocks will crush commodities. So I really don't like those ratio charts. Tell us the real reason why, and maybe it would help to go back to Bretton Woods, but why do you believe what you believe?
Exactly. And what I wanted to do was just put out the thesis, and now we can get into the reasons why I think that this thesis holds water. So I agree with you that commodities, in the long run, what commodities do is they essentially track inflation in the long run. Um, and you should not expect real returns on commodities, I believe. And so if we're going to see a 15 or $20,000 gold price in the next 5 or 10 years, then what you can infer from that is that I'm predicting inflation. And so what I would do is I've seen a lot of people, they harken back to the 1920s, they harken back to the 1990s as kind of corollaries to today. But I also think it makes sense to go back to the 1940s. So if you go to, World War II, the United States essentially hit debt to GDP levels that we just recently surpassed of around 120% debt to GDP.
That's federal government debt to GDP. So just the US
Mhm.
Congress, what Congress decides we need to issue a deficit, and then Treasury actually makes it happen by issuing the debt. That's what you're talking about.
Exactly. So at around 34, 35 trillion, if you have a GDP that is, starting to approach 30 trillion, then you're at that 120% level. And so in 1946 and 1947, we had about 12% inflation each of those years. So we immediately had basically a 25% inflation rate over a 2 year period. And then we entered into 48 and 49, which was a recession period. And then we entered what happened at that point in time was that the Bretton Woods scenario that Harry Dexter White, who was the Undersecretary of the Treasury at the time, and John Maynard Keynes put in place, that was really set up with two main things. They put in a World Bank, which was to fund the development of countries. They put in the IMF, which was originally supposed to be called the International Monetary Union, but it was too globalist, so they changed it to International Monetary Fund, the IMF, and those essentially were failures. They immediately following World War II, there was a dearth of dollars. There was a starvation of dollars around the world. The UK, in particular, needed a $3 billion loan from the United States. It was similar to a Lend-Lease type situation where Britain needed to be bailed out by the United States. But even that $3 billion loan was not enough. And so what happened was a $15 billion plan, the Marshall Plan, which was to seed Europe with dollars, and they did a similar thing in Japan, in Asia. And so what happened is all of this money flowed into the system, and you eventually got to the liquidity that the world needed. What's happening right now is that we're in a situation where sovereign debt levels have reached such highs, whether you're talking about Germany, Japan, United States, even China is getting close to 100% debt to GDP, that there's going to be another craving for dollars and for liquidity, and that this craving is going to need to be answered. Otherwise, we're going to hit a collapse. And to fund this, liquidity need, then the result is inevitably going to be inflation on the levels that we saw in 46 and 47, that we saw in the 1980s. We're heading into a high inflation environment and a sustainable inflation environment. And I think that's the only way to bring down debt to GDP, which is what we did post World War II. We had an immediate 25% inflation, and we brought that debt to GDP down from 120% to about 95%.
So the world needs dollars. Bretton Woods conference, as World War II was coming to the end, it set up the World Bank and the International Monetary Fund, which at first was called the International Monetary Union. Talk about how the monetary system changed before World War II, going into World War. I think a lot of people think that we had a gold standard. I view it more as a sterling standard, where A lot of currencies were pegged to the British pound, which itself was pegged to gold. Tell us about the monetary conditions that led to the collapse of the British Empire and the dollar replacing the pound sterling as the reserve currency, and why the world needed dollars after World War II.
You're correct. It was a pound sterling system prior to World War II. And a lot of this was because of the British Empire, right? So, as the saying goes, the sun never sets on the British Empire. I believe at one point over 25% of the world's population was under the Union Jack. And the pound sterling was the currency. And interesting is that the London bankers, which oversaw this, were very worried that after World War II, when the British Empire began to collapse one after the other, that basically they were going to be out of business. And they figured out a way to stay in business. It's a fascinating story. So the City of London, which is the term for the Wall Street of London, is a very specific area in the center of London. It's also known as the Square Mile because it's about a mile square. And it's where all the big London banks are headquartered. It's also where the Bank of England is headquartered. And this area, this brings in a little bit of the financial history, actually was the only area in the United Kingdom that was not conquered by William the Conqueror in 1066. And it was given special rights and privileges. And these special rights and privileges were extended in the Magna Carta in the 1200s, and they continue to this day. So your listeners might not be aware, but the City of London, there's only two cities within the broader geographical area of London. There's the City of London and there's the City of Westminster, where the government is. And both of those are cities that have their own local authority, their own police departments, their own structures. And in the City of London, unlike anywhere else in the democratic world, the voters are not individuals. The voters are the corporations and companies that are domiciled there. So in the City of London, which has its own police force, it has its own mayor. They do a parade every year on November 11th. The Lord Mayor's parade. They basically, are a law unto themselves. And so what happened after World War II is they realized that we can still make money. We just can't do it in pound sterling. We need to do it in dollars. And this was the creation of the Eurodollar market.
Mel, explain why.
Most people, Eurodollar, they might have heard of it. They're like, isn't that like dollars that are domiciled outside of the United States, not under the auspices of the Federal Reserve? Yes, that's basically what it is. But it is, in fact, the largest pool of dollars in the world. So there are a certain amount of dollars that are held in the United States. And then there are these, what they call Eurodollars. And that's just a dollar held anywhere. It could be held in Tokyo Bank. It could be held anywhere. And what happened was the Soviet Union actually was afraid that, the United States could essentially confiscate their dollars. And they did not want to hold their dollars in a US bank. And they went to a London bank in the 1950s and they said, we want to hold dollars. Can you hold dollars? And a kind of wink, wink, nudge, nudge deal was made between the London banks and the Bank of England to say, look, if you're going to hold dollars, these are not pound sterling, and we're not going to regulate it. And what they did was they proceeded to take their overseas territories, places like the Cayman Islands, Bermuda, the island of Jersey, Gibraltar, all of these overseas territories that Britain held on to. And there's a reason why they held on to those territories, even though the rest of the empire fell, was they were able to turn them into offshore havens for dollars. And to this day, London banks process over 25% of dollar transactions through this Eurodollar market. And it could be legitimate and it could also be illegitimate. So it could be cartels, arms traffickers, what have you, that take advantage of these tax havens. And so this entire dollar system that fed the bank's profitability in London was put into place to replace the sterling system. Basically, the dollar which became the surrogate for gold. And in post World War II, the United States had about 20,000 metric tons of gold. Nixon suspended convertibility in 71. At the same time, he also put in price controls and did a bunch of other stuff. But basically, at that point, we were down to about 8,000 metric tons, which is where the Federal Reserve's holdings sit today. And so once we went off of the gold, it was all fiat. That was the final straw to basically put this debt spiral into place that people have been talking about since before, you were alive, before I was alive. And basically what's happened is it's now, I believe, reaching a crescendo. And my belief on that goes back to the main expenditure of the United States government, which is Social Security and Medicare, and something that happened in 2020, 2021, where we stopped running Social Security surpluses. And now we've moved into a deficit position, and we're going to essentially run the Social Security Trust Fund dry over the next 6 or 7 years.
So I'm going to simplify and skip a few things. So the reason that the world needed dollars after World War II was the sterling was over as a global reserve currency. I would even argue unofficially that in the post World War I era, it really was actually a dollar standard, even though it was officially a sterling standard. But at Bretton Woods, dollar has become gold. The rest of the world's currencies are going to be pegged to the dollar in the same way that currencies used to be pegged to gold. And the dollar would be pegged to gold. And if there was any imbalances between the dollar and the franc, the IMF would intervene to set things right and restore. So you wouldn't have competitive trade balances where France would devalue the French franc in order to boost the French economy because things would be cheaper to produce there. Tell us about the Bretton Woods system from 1945 to 1971 when the US suspended gold convertibility. What was the debt growth like there? How is that period different from after the US went after gold?
Well, I think in some sense you can almost look at this whole period between World War One and two Bretton Woods as this time of transition. So I think it's also important to understand what was the global dynamics post World War One. So many British bankers and economists um, cynically believe that the United States purposely waited to enter World War One until the end in order to essentially bleed dry European countries. And so,
And Mel, whether or not you believe that that was the US intention, I think it is a historical fact that that is what happened. And that after World War One, all of Europe was basically broke and it net owed US a tremendous amount of money,
mm,
and something like 75% of the world's gold was in US because everyone, all the French and British were buying weapons and stuff from gold. So gold was just flooding from Europe to America.
yes, exactly. And the mechanics of it, to get a little more detailed, was that the United States during World War One lent huge amounts of money to Great Britain. Great Britain then lent money to France and Belgium and other allied countries. And so at the end of World War One, you had Britain in huge debt to the United States. You had France indirectly in huge debt to the United States through Great Britain. You had Germany in huge debt. And not only did they have huge debt, they also had the reparations demands, which led to the creation of the Bank for International Settlements in Basel, Switzerland, to handle reparations demands in 1930, which is another one of these intergovernmental organizations like the IMF and World Bank that's involved in these things. But basically, that situation where you can look at a corollary today where you had all of this huge debt in Europe, and then you had the United States with not only gold, but also the world's manufacturing capacity because Europe was destroyed. And so what happened, essentially today is you have Europe and the United States in huge debt, and then you have a lot of the world's manufacturing capacity in China. China is kind of the new entrant into this system that was not really there post World War One or post World War Two. Just to tie this all together of how it gets to Bretton Woods is that we had kind of a repeat situation after World War Two, where once again the United States had vast majorities of the world's gold, and Europe was essentially in debt to the United States. And what we have right now is a situation where, the Federal Reserve with the highest interest rates. I mean, you look at the bond yields. So the German 10-year yield is somewhere around 2 something percent. The Japanese 10-year yield is about 95 basis points. And so you have capital coming to the United States because we don't hold all the gold, but we do hold the dollar manufacturing capability. And since we can manufacture dollars, capital is coming to the United States. And that's why our stock market is trading at a forward PE vastly above of what China's trading at, or the European bourse are trading at. And so I see basically a similar situation to the 20s, where you have capital flowing into the United States stocks. We have a similar situation where there was a vast technological boom going on in the 20s. RCA was one of the hottest companies with radio, General Motors. So you had cars and radio and all of these amazing things that people thought were just going to be spectacular growth engines. And they were, but it took, 20 years for RCA stock to get back to the highs that it gotten in the 30s. And what I worry is that we're putting, 25, 30 multiples on Google and Amazon and, Meta and all of these amazing companies and their tie-ins to AI, because we're having capital flight to the United States because of higher interest rates. And that once this system begins to unravel in the same way that it did in the 1920s, then you're going to get the collapse. But I think before we get that collapse, we still got a ways to go in this bubble inflation, and that's why I think we could easily see S&P 6,000 within the next 12 months and S&P 7,000 in the next 24 months. And at a certain point, it's going to, basically get so blown up that people are going to realize, hey, this can't go on forever. And once people start, searching for the exits, it's going to be, like a game of musical chairs, and it's going to start crashing down. And this, in turn, is going to lead to people to realize we cannot have a dollar as the world's reserve currency, and we need to come up with something along the lines of what Maynard Keynes suggested in Bretton Woods, which was a basket of currencies, something like a special drawing right. He called it the Bancor, which was a gold-based basket of currencies based on trade. And so you're in order to equalize trade and make onshoring in the U.S. and all these things, you're eventually going to need to get off of a dollar-based system.
Forward guidance is brought to you by VanEck. The VanEck Morningstar-wide MOAT ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? MOAT strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide MOAT ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. Why now? So since Bretton Woods, the rest of the world has needed dollars, and the US has produced those dollars that the rest of the world needs. So that means it is printing money by borrowing money from the private sector and the rest of the world, and that it's going to run probably a trade deficit. It's going to import more than it exports because it's also exporting dollars, and then that nets the things. And it has a positive capital account. Money is coming into the US. The system has run for 80 years. What is going to cause it to unravel, in your opinion?
In my opinion, it's going to be bond market investors recognizing that interest rates need to be higher than what they actually are right now in order to keep up with the coming inflation. However, this coming inflation is necessary to deflate away the sovereign debt bubble. So there's about $330 trillion of sovereign debt around the world. And all of these countries are in this situation where it's basically, untenable.
Explain why a 120% debt to GDP is untenable? Why can't it go to 130%, 150%?
What we've done recently, especially since COVID, it's gone off like a hockey stick, and it's growing faster than GDP. And so there was a report by the Congressional Budget Office that it did a 50 or 60-year projection, that at these levels of deficit spending, debt to GDP would reach over 500%, by like 2066 or something like that. So growing at 2-3% a year, when you have real GDP growth of 2-3% a year, that's completely sustainable. When you're running a 7% deficit, which is what we are now, that's simply unsustainable. And what's happening is interest expense is skyrocketing. So I have in front of me the April Treasury statements. So this is the monthly statement of the Treasury. And what I have circled here is gross outlays. So this is total interest on the public debt, fiscal year to date as of end of April, $624 billion the United States Treasury has paid out in gross interest. Last year at this time, it was $460 billion. So that's a 35% increase in interest payments in 1 year. Imagine you're an individual with a credit card and your interest payments are going up 35% a year. It only takes 2-3 years before that just gets ridiculous. So if we're at $1 trillion in interest expense right now, and we continue growing at 35% a year, you see where this gets us. And so this is why I believe we're now in that hockey stick moment where it's just getting out of control. And we're seeing the Treasury just released a new batch of bills, 6-week T-bills that they've never done before. Yellen also announced Treasury buybacks. So she's buying back Treasuries. She's been doing a lot of bill issuance. And what's that is effectively de facto yield curve control, where you're limiting the amount of coupon issuance.
Wait, what is a de facto yield curve control?
If the Treasury were issuing bonds in the types of denominations that they normally do, we would have had over the last 12 months a lot more 10, 20, 30-year paper come out onto the market. And once in October, Yellen realized that Treasury demand was waning. And this was the same period of time you had people, not just me, you had, Jeffrey Gundlach on CNBC after one of those Fed meetings saying, hey, the Treasury market is starting to get a little skittish here. So this was when people were you had Griffin from Citadel, you had different big names coming out and having these issuance concerns. And we haven't heard those in the last number of months since October, because Treasury has been funding huge amounts of the debt with bills. And what that's doing is it's feeding into the money markets and the bank reserves. And that ties into the ISDA letter, the International Swaps and Derivatives Association, asking for essentially regulatory relief to hold Treasury bonds not as part of their tier one capital, that they can hold an infinite amount of treasuries. And so I don't necessarily know if it's going to be QE, or it could be some sort of financial repression where the banks are essentially turned into these massive buyers of treasuries. But essentially, we need to artificially keep the long end rates low. And this was, the comments of one of your other guests, George Robertson, talking about his belief that the true yield curve is better approximated by looking at the mortgage-backed market, which is right now around 7%, because that actually has a government guarantee to it. And if you back out, the costs associated with bundling mortgages, you might get a 10-year yield at around, 6.5% right now. And that is why the yield curve is not really inverted. And that's why we're not heading to a recession. And that's why we're probably heading to 6% nominal GDP growth, which is going to be a combination of inflation and real growth. And that's why investors are going to look at this and they're going to build up the stock market, because they're going to see spectacular nominal GDP growth in the future.
You're absolutely right that the US Treasury and Treasury Secretary Janet Yellen issued more short-term treasuries, i.e., bills, than coupons relative to expectations. And I bet that probably did have a positive impact on liquidity, a positive impact on the stock market, and a positive impact on long-term bond yields, i.e., they're maybe they're a few basis points lower. I would disagree that that is yield curve control. I mean, yield curve control is when the central bank, which can infinitely print money, says 2%. That is the top level, and anytime it goes to 2.01%, you're going to lose money, investors, because we're going to buy it and we have an infinite printing press. Relative to that ginormous money printing machine and a guarantee, which no other financial player, not JP Morgan, no one, Warren Buffett, could ever match. I think having coupons go from, it was expected they'd be 22% and it's 18%. I don't know the numbers, but it's pretty small ball. Would you agree that it's kind of a stretch to say that that's yield curve control?
I would say it's yield curve control light. I would
Very light.
it's very light. It's very light, but on the margins, it is impacting things, and I think it's keeping things within this range because there is this other thing that we haven't talked about, which is the stress in the banking system of these higher rates, because the Treasury and the Fed essentially told banks, after 2008, buy Treasury bonds, and Treasury bonds had almost no yield, so they started buying or excuse me, they started buying, 10, 20-year paper. And that was essentially, assets held against short-term liabilities. And so we have the regional banking system right now underwater. I mean, in a real sense, many of the banks in this country are insolvent. And by insolvent, I mean that if all of their liability holders, all the depositors said, we want our money, then they would basically go under. We haven't seen runs on the bank because, there was basically a de facto guarantee implied after SVB. And these were the exact type of situations that FDR was wrestling with in 1932, or excuse me, 1933. He was elected in 32. He took office in March of 33, where he sat down with his advisors and he talked about what are we going to do. And one of the things they talked about was just a straight up, haircut on government debt. He talked about basically calling all U.S. Treasuries, and he was willing to basically print dollars to buy all the U.S. Treasuries back, and this was going to cause inflation. His advisors talked him out of it, and they did a bank holiday, and he went on his fireside chat and he told people, don't, take your money out of the banks. We're going to be okay. We've got a plan. And they were able to kind of keep things moving until World War II. But really, the whole 1930s were not a good time.
In the banks. Oh, yeah. Understatement of the century. The 1930s were not a
Yeah.
good time economically. But Mel, wasn't the banks had enormous credit losses because there was a Great Depression, and that is a self-fulfilling prophecy. Wasn't Treasury yields, because there was a Great Depression, bond yields were very low? Weren't banks sitting on mark-to-market gains rather than mark-to-market losses as we have now?
The way that the banks had their losses back then was that they had been loaning out a lot of what they called brokerage cash, which was to fund the 9-to-1 leverage in the stock market. And so at the peak in October, the margin rates were 20+%. And so banks were literally, and this actually led to an initial collapse in Germany. So Germany had needed capital after World War I, and they had been paying higher than average interest rates on deposits. So they'd been paying like 5-6% interest rates on deposits, and so a lot of capital had gone into Germany. But in the heat of the stock market bubble, what happened was people realized that they could loan brokerage cash so that people could lever up and charge 20% interest rates. And all this money flooded out of Germany, out of Europe. And this was part of that spiral that began, and culminated in the great crash in October of 29. So there was a lot of, transatlantic type stuff that we're seeing now, where you have a situation, for example, in the UK, where a lot of homeowners are going to have mortgage resets coming. And the UK simply cannot keep interest rates where they are. They're going to have to cut. Same thing in the ECB is going to have to cut. And I think that's why when Powell came out in his last speech and he sounded rather dovish, and people are saying, well, why is he dovish? Why? Because I think he understands that he cannot raise rates. And in fact, he's going to most likely need to cut rates multiple times this year, regardless of whether inflation is bumpy or not.
I think everything you said is true, but I think you connect things that are not related. So, like, yeah, as you said, the issue with the banks in the 1930s was they were insolvent because of credit losses. They had loaned money to someone to a mortgage. The house collapsed. They couldn't make the payment. They loaned it to stock speculators. The stock market crashed. That was the cause of the losses. It was not that they had marked market losses on their government bonds because interest rates shot up. Interest rates actually declined. So the issue with the banks now, definitely of last year, was huge mark to market losses, which some banks thought they could just paper over and say, oh, this is in held to maturity category. Silicon Valley Bank, First Republic Bank, on this program, as you may know, we covered that extensively, and that definitely was an issue last year. I think in the scenario that you describe, where the economy not only doesn't go into a recession, but it reaccelerates, I actually think that that is not going to be an issue at all for banks, because they're just going to be making so much money on higher yields. If you lose money on a mortgage or on a loan because of credit, because you're not getting paid back, there is no opposite effect to balance that out. It's just a loss, and it could actually have a negative consequence, negative knock-on effects. Whereas if you lose money on a bond because interest rates went up, you're going to be making more money on loans eventually. It's just going to take some time, and some banks couldn't make enough money. But I think I have definitely covered the risk to the banking system of higher rates in terms of losses as well as rising deposit costs. And I think, in my not so informed judgment, but I do think that it's looking a lot better.
Mhm.
But you said something about the UK, about mortgage. The UK will have to cut rates because, unlike in the US, in most of the rest of the world, mortgages are effectively floating rate or fixed rate, but short duration. So there's no, oh, I got a 3% mortgage at 30 years. And even though mortgage rates went to 7%, I'm fine. And, my kids could get my house and they'll still be fine in 2050. That doesn't really exist in the rest of the world. So UK mortgage holders, they're impacted already by rising mortgage rates. That is going to crimp mortgage credit because they won't be able to afford it. I get that, because the private sector, not just individuals, but even corporates, can't print their own money. What isn't that fundamentally different, though, than the government not being able to afford higher rates? Because the US government can always print its own money, and the demand for dollars is so high. Basically, interest expense has gone up because interest rates have gone up, because the Federal Reserve has raised interest rates. The US can afford it because you can always just issue more bonds. And some people, would compare this to a Ponzi scheme. But I think, the US government has special privileges that no other private sector actor has. And above all other governments, it has an even higher privilege because everyone wants dollars, and no one wants the Argentine peso. Sorry. Why can't this continue? That's kind of my fundamental question.
What I believe is that you're absolutely right. The propensity for the U.S. to continue to print money, I think, is a lot greater than a lot of doomsayers have talked about. So there were people after 2008 saying, "Oh my God, the Fed balance sheet's going to go to 4 trillion. What's going to happen?" And we took it to 9 trillion during COVID. And if you look at the Bank of Japan, which holds 100% of GDP on its balance sheet, if you were to do that in the United States, that would be 30 trillion, and we're only at around 8 trillion. So there's a whole lot of room on the United States balance sheet or on the Federal Reserve balance sheet to hold U.S. Treasuries. If you were to say, well, look, they were able to do it in Japan and they didn't have an inflation issue. The demographics in Japan are very different than the demographics and the growth in the United States. And one thing I would point to is, while Japan has been able to hold 100% of GDP, JGBs, Japanese government bonds, look at what happened in the stock market during that period. Nothing. So basically, what I'm saying is that I don't think that the government is going to run out of money. But what's going to happen is that again, this comes back to the Social Security. So we talked about in 2020, 2021, the Social Security Trust Fund had been running a surplus, and what that enabled the Treasury Department to do is to take that surplus and then sell to the Social Security Trust Fund these special Treasury bonds that only the Social Security Trust Fund gets to buy, and it funds the government. That extra source of funding was taken away, and it's now declining rapidly. And then in 2030 or thereabouts, the Social Security Trust Fund is essentially going to go empty. And at that point in time, there will still be money coming in, right? Because you have all the workers are paying 6%. So it's not like when the trust fund goes empty, the government has to pay everybody's Social Security benefits. But there'll be about a 25% shortfall between the money that's coming into Social Security and the money that needs to go out. And so what I'm postulating as the impetus for the crisis is that once bond investors recognize that this huge, so Social Security is the largest outlay so far this year. We have outlaid $837 billion in fiscal year 24 year to date at the end of April to Social Security. It's by far, I mean, just for comparison, national defense is 498. So we're not quite double national defense, but Social Security is a big, big line item. And if we're going to have to now start funding 25% of that, combined with the fact that the US economy has gotten used to this fiscal impulse, this fiscal deficit spending, you see all of this government jobs and all of that, that bond markets are going to recognize that there's going to need to be so much issuance that they're going to want higher yields, but those higher yields are not going to be able to be stomached by the economy. And that's why you're going to take what I've called yield curve control light, and you're going to have to juice it up even more, where you're going to start telling banks, you can't send, capital offshore, or you need to hold US treasuries, but it won't affect your tier one capital requirements. So you'll be able to loan out, X amount of money off of this. And so it's not going to be like, oh, all of a sudden the US government, can't pay its bills. It's just going to be the market's slow but steady realization that the amount of issuance coming is going to demand higher rates, and that there's not going to be the stomach for it. And so that's why you're going to get places like the Federal Reserve involved. And then what that's going to do is it's going to cause stock market investors to see liquidity, and they're gonna jack up the markets. But eventually that has to come to an end, because trees don't grow to the sky. So once the stock market gets to 30 or 35 times forward earnings, there's going to be some investors that it's a tipping point, and they say, you know what, I'm taking my money out. And once people start running for the doors, that's how you're going to get the collapse, which is, by the way, the traditional modus operandi of bubbles throughout history, whether it's tulips or anything, is that people think you can't lose, and then everybody gets in. And then when everybody's in, all of a sudden, some people start saying, hey, I'm cashing out. And once a certain critical mass of investors say, I'm cashing out, then you're going to start seeing the collapse.
In your script, to take Andy Constant's thing, that the script in your personal script, the immense amount of US government borrowing is going to cause bond yields to rise. That's where I'm with you. Step one. Step two, you say the economy won't be able to handle it, i.e., mortgage rates at 9%, we're going to have a recession. So rates are lower and there's yield curve control to Federal Reserve. Obviously, on the short end, the Federal Reserve has complete control. On the long end, it's going to enact some sort of yield curve control, which it did in the 1940s. That is where I'm having trouble with it, because isn't there not a virtuous cycle, but a cycle and an equilibrium where, okay, a too hot economy with too hot inflation caused bond yields to rise. Bond yields rising causes the economy to slow down. We might even cause a recession. And then in a recession, bond yields should go down, because if inflation is at 1%, a bond yield at 5% is an obvious steal. So you buy it, and then it goes to 3%. And then low bond yields cause the economy to recover. Up, down, the cycle. Why can't that continue? I mean, what is wrong with that logic? Why are you taking it to the Federal Reserve has to enact yield control?
Because they cannot allow there to be another significant recession, because the deficit spending is not what it was in 2008, 2009. And so in 2022, when the stock market went down, we didn't have a recession, but tax receipts were just killed. And so you're going to make this matter even worse if you have a recession. And so basically, we're almost entering into a time where the monetary and fiscal authorities cannot allow for a recession. That the political impulse will be to deficit spend our way away from the recession, and I think that's what happened last year. I think a lot of people were expecting a recession. The Federal Reserve raised rates, and they said, "Okay, we should have a recession," and kind of pay the piper for all of this COVID spending. And we never did pay the piper because basically, if we would have continued down that path, we would have had, instead of 7% deficits, we would have had a 10% deficit in fiscal year 2023. And so the government is just, it's like an addict. It has to inject more and more and more spending and liquidity and bonds, and it's going to keep doing that to stall off a recession as long as it can. And that the side effect of that is going to be inflation of financial assets, housing, gold, stocks, and then people start moving into there. And then this is essentially kind of, I'm describing the anatomy of a bubble, is that the government is instead of letting interest rates go to 9%, they're going to control that, and that's going to be the fuel to the fire of liquidity and asset bubble prices. That's going to lead to S&P 7,000 in the next 24 months, and home prices to go up again, and all of these things are going to happen. And then at a certain point, like I said, there's going to be a critical mass of investors who say, I want to take my gains and go home. And once people start heading for the door, why did the tulip bubble collapse when it did? It could have conceivably gone up another 100%, but it didn't. At a certain point, investors said, okay, enough is enough. And they're going to start heading for the door. And that's when tax receipts are going to go down, because the stock market and capital gains are a major driver of revenues for the government. And when the government all of a sudden is losing tax receipts because the stock market's going down, they're going to have to issue even more debt. And then this yield curve control is going to start to become untenable. And that's when I think you're going to get an international call to say, hey, we need to rethink this monetary system. We need to figure out a different way of doing things than funding the whole world's economy on essentially US debt.
So you said, if and when there's a next recession and the stock market goes down, that the US government is going to have to issue even more debt, which is going to cause bond yields to rise. Empirically, though, doesn't that not happen? When the US government issues a ton of debt, it's because there is a recession, yes, but actually bond yields fall because everyone wants debt. What is going to cause? You see, the World War II, sterling was completely wiped out. The British. Don't you need a monumental event to cause what you're saying? Debt to GDP, it went from 60% in 2007 to basically 100% in 2013. And then it was flat. And then 100% to 130%, 125% in 2020. But since then, debt to GDP has actually been going down because the nominal GDP has been growing faster than the debt, right?
Well, not last year. No, I think it was deficit spending was like 7%. Nominal GDP was like 5.5 or 6%, I think. So it's still not quite there. But what I think is different this time is that in all those other instances, whether it's 1933, whether it's the S&L crisis, whether it's the dot-com crisis, whether it's the GFC with housing, is the bubble was in an asset other than treasuries. And so what happened was, in a time of market stress, everybody moved into treasuries as a safe haven. What I think will be different here, and this is actually part of the plot of QUOZ, is that when there's a time of market stress, all of a sudden the dollar and treasuries are not rallying. And that's what's going to be new, is that a time of market stress, and what you're going to see rallying, I think, is going to be things like gold and real assets. And then you're not going to have the rally in the treasuries that you normally would, because that's where the problem is this time. And in the past, the problem was not in the treasury market.
How is the problem now in dollars against other fiat currencies? The issue of bond yields and duration of owning a 10-year bond, whether it's a German Bund or a Japanese government bond, JGB, or a 10-year treasury, all of them have lost money in all currencies. But when it comes to the dollar versus other currencies, the dollar's been strong, right?
The dollar has been the best house in a bad neighborhood for sure, and that makes sense, right? Because ultimately it's a dollar system, and the dollar has that ability. But what the U.S. government is afraid of is a strong dollar, and when you get a strong dollar, so if you start having distress in these other places first, like the UK or Germany or China, and people move into dollars and you strengthen the dollar, then that is when you get, yields up and you get these problems. So we had the dollar index at, I believe, 114 or thereabouts, during the time of crisis last year. And now the dollar index is at around 105. So we've had this amazing rally because of dollar weakness. And when we had the dollar strengthening, that was when we were in trouble. So the dollar and the currencies are all tied into this, and that if you get into a situation where there's this need for liquidity, and the dollar starts going up, then that is exactly going to coincide with higher yields, and it's going to coincide with this market stress.
Got it. But why would other countries dump the dollar? What's in it for them?
They would need the dollar to pay their international trade. So, China is the world's largest net importer of oil. They're the second largest foreign holder of treasuries. And when they need to buy oil, they're working out arrangements to buy with yuan and other things. But they've already stopped buying treasuries. They were buying tons of treasuries, and now they've basically held flat. And other countries would do the same. Japan, with their currency, they cannot let the yen go into free fall. It hit 160 last week or so. And so they're the largest foreign holder of treasuries. And if they sell treasuries to essentially buy yen, to strengthen the yen, then again, you're going to have more treasuries flooding into the market. And you're just, not only are you having US issuance, skyrocketing, but then you could get central bank foreign holders of treasuries selling. And so it becomes this perfect storm where you have, just tons of supply, and who is going to mop that up? I mean, there was, I think, 10, 15 years ago, like 25-30% of US treasuries were owned by foreign central banks. And now that number is down to like 10 or 12%. And so it's US insurance companies, it's banks like JP Morgan. And that ties back into that is the letter, where they asked to be able to hold treasuries without it counting against their tier one capital, so that the banks are going to be called upon to swoop this up. And you have things like stable coins, which also hold bills, T-bills. And you just had last month a bill by Senators Loomis and Gillibrand, the Stablecoin Payments Act, which was not passed, but I think it's eventually going to come, which requires that stablecoin custodians use a depository institution underneath the Federal Reserve. And so they're trying to swoop in all this, stablecoin money. I think that instead of a CBDC, they can basically take these private stable coins and have them mandated to hold their deposits at banking institutions, which is what this bill does. So it's like a backdoor CBDC. And this is going to essentially allow the government to continue to print larger amounts of bills and do everything they can to keep that long end issuance low. But at a certain point, they just can't keep it. There will be a tipping point.
Tell us your specific prediction about the timing. You said, was it 2027? Your argument, I think it makes sense to me. Not saying that I think it is going to happen or that it isn't going to happen, but like the follow through does make sense. But I might say, in the mid 1990s when I was born, it might have made sense to me too. And here we are, close to 30 years later, and it hasn't happened yet. So just because an argument makes sense doesn't mean it's going to happen, and it doesn't mean it's going to happen at a specific time. So, what is it about 2027 that you think things are going to heat up, and describe in detail your prediction? So you think the stock market is going to melt up from here until 2027, and then in 2027 what happens? So tell us your prediction first, remind us, and then explain why it's going to happen specifically in this time period.
I believe that the Federal Reserve is going to cut rates this year. I believe they're going to be forced into it regardless of what inflation does because of the global macro picture with things like we talked about, that they're going to need to be cutting in Europe and they're need to be cutting in UK. And if they don't cut, that the dollar is going to get too strong. And so this is going to inject the liquidity. This is going to fuel the animal spirits. And we're going to continue this melt up for into the election. And then whoever wins is going to obviously want to continue this in the beginning period. And so they're not going to upset the apple cart with, like, whether it's Trump or Biden, they're not going to say, okay, we need austerity, we need to cut, spending. They're going to keep that spending going. And the markets are going to see all this. They're going to see lower rates. They're going to see continued fiscal deficits at high levels. And they're going to say, this is just great for the market. This is great for nominal GDP. We could also get a bump from AI productivity. So we've got this AI fiscal spending, lower rates, soup that's going to fuel this rally, I believe, until about 26 or 27. And what I think is going to happen at that point is that people are going to be looking at the Social Security trust fund, and they're going to start saying, hey, we're now paying out a lot more of the Social Security benefits than we're taking in, and we're not getting that boost of free money from excess Social Security, and we're getting into trouble where we're going to have to issue even more and more bonds, and that at that point the market is going to start recognizing it. The bond market vigilantes, if you will start coming in, and we'll see these renewed tails on Treasury auctions, and that's going to essentially like make the market nervous. And and then people are going to say, wow, S&P is at 7,000. I should take my gains and get out and go home. And people are going to start heading for the doors. So what I feel is it's going to be a growing realization of the necessary issuance that needs to happen at the end of this decade because of Social Security Trust Fund going broke, but that the market's going to anticipate that by a year or two, and that's when the people are going to start heading for the exits.
So tell us about Social Security, quote unquote, growing broke. So you're saying that the Social Security was running a surplus until 2020. So why the hell were people talking about Social Security going broke, in 2011 when it was still running a surplus?
I have no idea. I have the numbers here. I mean, the accumulated holdings of the Social Security Trust Fund in 2019 were 2.8 trillion. The next year, 2.9 trillion, and it was in 2021 where we started going down. We went back to 2.8 trillion. So there's still 2.8 trillion. Then it goes to 2.7. By 2027, we're at 2.2 trillion, and then it really starts like almost like a free fall, and starts going down, so that by 2032, according to this report, we're at less than a trillion. Now, the thing about these CBO reports and predictions is they predict no recessions. They predict everything going great. And so it could be 2032, it could be 2033. I think it's going to happen a little bit sooner, closer to 2030, when the trust fund goes empty. And then that's where I peg on like a year or two of stock market anticipation of this happening. And I get to 27, 26, 27, 28, sometime during the next presidential election cycle, where the market understands this. And I think even Jeffrey Gundlach said that debt and deficits are not a major issue for the 2024 election, they will be the major issue for the 2028 election. And so I think as we head into the end of this decade, that's when this is going to ramp up. I can't give you like, May of 2027, that's when it's all going to come down. I have to give a broad period, and I can't underestimate the ability of Treasury or the Federal Reserve to continue this, you know, charade. But I do think that there is an endpoint coming, and it's probably going to be before the 2028 election, and that's when we're going to have the rubber meet the road.
Mel, isn't the issue with Social Security entirely political? In other words, from a financial standpoint, it is ridiculously easy to solve. And I think you could write a bill that would, I don't know, 30 words. I could say, you say, okay, instead of funding Social Security with a payroll tax whose surpluses go into a special trust fund that pays Social Security, or if they have deficits, as we do now, it comes out of the trust fund. It's just part of the government. And you fund it just as the same way you fund the firefighters or the military, or paying the congressional salaries. You borrow money, and if you have a national surplus as you did in 2000, then you pay it from taxes. But you pay it by taxes and tariffs, and the rest, if you have a deficit, you fund by borrowing money. That was maybe probably a little more than 30 words, but it's simple. And isn't you've studied financial history so much more than I have. You've read 200 books, which really is a lot if you think about it. There's so many things in financial history that are so much more complicated than this. And I'll give you an example. In World War One, before World War One happened, the bankers said there would never be a World War. Okay, fine, we'll go to war, but don't worry, the war is not going to last that long. Not longer than a few months, because we'll eventually run out of money. And that definitely was true using the pre-World War One gold standard rules. But political will just said, no, we'll just print more money. Easy, done. If political will is there, the financial barriers that seem like they are so impossible, they definitely are possible to break. So I agree that this definitely could happen, but it would be because of a lack of a political will, not because of a true financial reason. Do you agree or no?
I do agree that ultimately the politicians and the government have a lot more power than people necessarily presume, and you have to break that mode of thinking, well, this is the way the financial system is now, so if it stays this way, then it becomes untenable. But it doesn't have to stay that way. As you said, in World War One, that happened. It happened during the Civil War in the United States, where Lincoln issued his legal tender notes that were colloquially known as greenbacks, which were not backed by gold, and so they instituted this fiat currency. So the politicians always have in their back pocket, the essentially the military control of the state, and they can enforce things, but that will eventually cause a rethink, I think, in the financial markets, of saying, okay, if the United States government is not going to let, they're not going to tell people, okay, you can't collect Social Security until you're 75, or, which is Social Security is kind of an easy fix, because you can do means testing. You could take it away from millionaires. You could raise the age. You could raise the tax from, 6% to 8%, or whatever for employer. You could do things to kind of get Social Security solvent. Medicare is a little bit more difficult because of the intense costs, and the fact that unlike Social Security, where you could say rich people, you're on your own, it would be harder to take away health benefits from older Americans, even if they're wealthy. And so I think that they're going to find ways to keep this train moving, but there could be financial casualties along the way. And I think part of those casualties are going to be the purchasing power of the dollar. That's going to be the primary casualty, because in order to keep all these things funded and keep everything going, it's just simply going to have to be an inflationary period. And like I said, I think people are going to see that writing on the wall. They're going to say, hey, inflation's coming. Stocks do great in inflation, right? Stocks are priced in nominal terms. If Apple can sell an iPhone for $1,000, it'll be even better earnings if they can sell them for $2,000. And so that's going to essentially build this bubble, and that the death is not going to be necessarily because some external cause forces it. It's going to be a psychological cause where people say, okay, we're at 35 times forward earnings. Are we going to really go to 45? Are we going to go to 55? Like, when does this train end? And that's when people start heading for the doors. And it's essentially like a massive bank run, but not a bank run, a financial asset run, where people are going to say, oh, I want to sell my rental house. I want to sell my stocks. I want to take these profits and lock them in because they've been so amazing. And then you get this dearth of sellers, and you don't have buyers because people say, oh, well, I'm not going to buy stocks at 40 times forward earnings. And that's where the collapse happens. That doesn't mean society collapses, or we necessarily have World War III, or people are out in the streets, shooting each other and trading in gold coins. I'm not predicting that, but what I am doing is saying that the situation will get such that it's untenable. There will need to be some pain, and this will be I would say a 40 to 70% drawdown in the S&P, and that out of this, world governments will realize we need to adjust this dollar-based system. We need to do something more along the lines of what Keynes suggested, which is more of a basket of currencies, as like an international trade-weighted unit of account, and that's going to cause financial troubles.
How is Medicare funded?
The Medicare trust fund is much smaller, and a lot of Medicare does get funded differently than Social Security. So Social Security is completely funded by previous payers of Social Security. Certain amounts of Medicare are funded through current deficits, and so the Medicare trust fund, there's two different trust funds. There's like an old age and survivor's disability. Um, it's in just as bad a shape, and the CBO predictions are essentially around that 2030 timeframe for when the Medicare trust fund runs out. The only thing with the Medicare is that current law allows the government to make up that shortfall. In Social Security, current law does not allow the government to make up the shortfall. It's supposed to be completely funded by what people have paid in. And so there will definitely need to be an adjustment in Social Security law in order to allow the US government to fund it through deficit spending.
That would be a quick law to change. It's very fractious.
Yes.
Increase payroll taxes, cut benefits for Social Security. Elderly people, they vote. Unlike people
Mhm.
who are in their 20s, who some of them vote, some of them don't. But old people vote. Seems unlike now politically untenable to cut benefits. But yeah, I mean, it's definitely an issue, but it's going to get solved. So you think that? What do you think is going to happen?
It will get solved, but I mean, look, I mean, even in our lifetimes, right? We had a 50% drawdown in '99. We had a 50% drawdown in 2009. We had a near 50% drawdown in 2020. So in the last 25 years, we've had three 50% drawdowns. I'm not suggesting that this time, like I said, will lead us into you know uh, living in caves. What all I'm suggesting is that the good times are here. The good times are going to stick around because we've got the runway for another year, 2 years, maybe even 3 years. But at a certain point, we're going to have another one of these drawdowns, and I think that it's going to be significant. And unlike other times where we had these V recoveries and we immediately got back to highs, that this could be essentially kind of a lost decade. The 2030s could be kind of a lost decade for equities, where we might hit a high in 27 or 28, and we might not get back to that high until 37 or 38. And that people should be at least aware that that's a potential outcome here. And I think a lot of Americans are being told by Larry Fink, like, you just put your money in the stock market, and as long as you're holding it for 5, 10, 15 years, you're going to double your money. And I don't necessarily think that when people start putting their money in the stock market in 2027, that they're going to have their money doubled by 2037. It could be dead money. It could even be a loss in real terms. And so I just want to caution people to at least consider, my thesis as a possibility, and that we could be heading for trouble in the coming years.
If there's a lot of inflation, I mean, that seems very plausible. In the 1970s, the stocks do not like large amounts of inflation. Yes, profits go up, revenues go up, but so do costs, and it causes bond yields to go up, which means that it's hard to discount the future. So you have price to earnings ratios in the single digits instead of where they are now. I don't know, 28. So how high you think inflation is going to be? We went from a peak close to 9% inflation in the U.S. Now inflation is year over year 3%. If you depends on how you measure it, it's a little bit higher. On a 6 months, 3 month annualized basis. Where do you think inflation is going to be over the next decade?
I think we're probably looking at a 5 to 10 year period now, where if they're able to do what they want, their best case scenario, we're going to have a 3 to 5% inflation. And so, if you look at that over a 5 or 10 year period, I think that will help get debt to GDP levels around the developed world back to where they're somewhat sustainable. If they lose control of this, if people realize that there's a little bit of impotence to raise rates, that Powell can't pull a Volcker and raise rates to 10, 15% because debt to GDP is so high. In the 70s, debt to GDP was like 30%. And so when borrowing costs for the government skyrocketed, the government was able to absorb that. At 120% of GDP, the Fed can't take interest rates to 8 or 9 or 10%. It'll bankrupt the government. And so as long as they can kind of keep control, what they want to do is they want to keep those long-term inflation expectations anchored in the 2 to 3% time range. But I think they're going to be okay with an extended period, a 5 to 10 year period, where we're actually at a 3 to 5% range. And that's going to be the trick, that the balancing act they're going to try to pull off.
Okay, I thought you would have said higher. For me to see gold does extremely well and gold crushes stocks, which maybe are flat in nominal terms and have negative real returns, i.e., inflation adjusted returns. I would have thought you would have said inflation closer to 10%, such as you had in the 1980s. Actually, Vincent Deluard, longtime guest of my show, who you may know, he has a great work which shows, yes, a long run rate of 2% inflation, that's what is best for the stock market. But if your goal is to maximize nominal GDP growth, actually something closer to 3% or 4% is actually better. And some people are going to hate me for saying this. They even think a 2% inflation rate is a 2% stealing from savers. Which I
Mm.
mean that argument, there's definitely an argument for that. But why is it 3% to 5%? That doesn't really seem to me an environment where stocks collapse and gold goes to $10,000. I mean, I saw an excellent play last night called Patriot or Patriots, which was about Russia in the 1990s. And it really is an economically informed play, which, you don't get to say that often, about basically this oligarch who recognized there would be hyperinflation in Russia during the fall of the Soviet Union. And he just borrowed as much money as he could and bought a bunch of cars and then sold those cars for 3 times higher. And his liabilities were basically nothing because there was hyperinflation. And he was able to that's not the environment you're describing. You're describing an environment of the mid 1980s. I mean, like, for example, 1980 to 1990, I don't know, inflation averaged probably 4% and gold collapsed. So why is the environment going to be so good for gold?
I agree that with everything I've laid out, I understand why you're saying, well, I would have expected you to say 8, 9, 10% inflation. I do think that's possible. So if I was doing a scenario analysis, I had a worst case, base case, best case, in the worst case scenario, like I said, they lose control and you get massive spikes in inflation. But I think that they're going to do their best to try to manage it. And I think we've already seen like the economy, come in a little bit. First quarter GDP wasn't as robust as fourth quarter. So we're not in this runaway economy of like 8% nominal GDP growth. And I think that's really what they're trying to control it. And it's difficult to control, but I'm giving them credit that they might be able to pull this off and keep inflation, without spiking to those levels. We might get like a year in there when it spikes to 8%, and then the Fed raises rates again and does something, and then comes back down. But I'm kind of cost averaging 3 to 5% over a decade long period, which takes away about 70% of your purchasing power. Like a 10-year period of 5% inflation, I think takes away 62% of your purchasing power. So if you compound 5% over 10 years, you wind up with 1.62 of whatever you started with. And so, you can, factor that in. So that's still, so that's still kind of a massive, you know, inflation. I mean, if you think about a $500,000 home going up 60%, you know, that's going to be, you know, a $800,000 home, you know. And so I think that it's going to be significant. It's going to be hard for, you know, the younger generation that wants to buy homes. You know, if you're like a 30-year-old family starting out and you don't have the down payment. And so it's not going to be easy, even though I think it's only 3 or 5%. I think that that is going to have effects, but I don't think it necessarily has to get skyrocketing like 1980, where we get like 15%, but it could. It definitely could. You were asking me about gold and why would gold do so great in that
Yeah.
environment? And I think so there is a appetite on the part of the BRICS countries to infuse gold into whatever is going to replace this dollar denominated system in some way. I don't think it's going to be like 1915 where the pound is pegged at 4.2 pounds to an ounce of gold or whatever it was. You know, but I think that gold is going to become a part of it, and you've seen the central bank buying, and these are price insensitive buyers. They're continuing to buy. You know, Luke Gromen has talked about China wants to start buying oil from Saudi Arabia in yuan. Saudi Arabia is going to be happy to take a certain amount of yuan because they buy a lot of Chinese goods, but they don't buy that many Chinese goods, and they're going to want to net settle in gold. And so, as gold gets re entered as a true monetary metal used by the world central banks, even though we're not having this runaway 20% inflation, um, gold, you know, Luke's done work where he's like, you know, if you wanted to take U.S. gold reserves as a percent of foreign GDP, they kind of average like 40% for a lot of U.S. history. So, in other words, if you took all the gold that the Federal Reserve owns, you could immediately go out and pay off, you know, 40% of foreign treasuries, and now that level is, you know, less than half of that. So if we get back to like a 20, 30, 40% of foreign treasuries to gold, because gold has re-entered the monetary framework in a meaningful way, then that's where you're going to get the gold price. And that's where I'm a little ambivalent about, you know, a lot of people talk about the gold silver ratio, and that we're going to really see this huge spike in silver. And we definitely have seen it recently, and silver's playing a little bit of catch up. But if you look over the long run of human history, the gold silver ratio has been steadily declining, right? So when the country was formed, we were at a 15-to-1 ratio. Within a decade, the U.S. government needed to change it to 16-to-1 silver to gold, and now we're at like, you know, 80-to-1 or something like that. So I do think that, you know, industrial metals like platinum and silver are going to do well, but I think gold has the potential for real outperformance because it gets moved into the monetary framework in a meaningful way that it hasn't been since the 1970s.
Mel, if you were to tell me inflation is going to be hot, and whether they're right or they're wrong, central banks, including the Fed, but also China, India, they're going to be buying a ton of gold, and that's what drives the price up of gold. More people who want to buy it than people who want to sell it, and gold goes up. I could totally see that. Just in other words, gold as a percentage of foreign reserves, gold as a reserve asset increases, and it takes few percentage points away from U.S. Treasuries. I could totally see that. And that, I believe, is Zoltan Pozar's framework of Bretton Woods 3. Even though Bretton Woods 3.0, it sounds like a huge change, that's really what it is. It's just gold playing a bigger role as a reserve asset. Involves no peg whatsoever. I feel like once you get pegging fiat currencies to gold, I feel like, haven't we learned in history that ends as a disaster? Is that what you think, or are you believe in the much more mild view of, you know, the impressive sounding Bretton Woods 3.0, where okay, China buys gold, you know, so what?
Yeah, a more mild view. I mean, I think Keynes called it the barbaric metal that kind of shackled governments, and I don't think will ever make that mistake again of going back to like whatever the gold is. That's the amount of money supply in the world. But I think that it can be used as an anchor. It can be used as something to essentially handle these trade, you know, current account and trade deficit type imbalances, where you know, currencies that are able to hold more gold will hold their value better, and currencies that need to just print ad infinitum, will be weaker, and that the cost of that weakness in the currency is going to be inflation in those countries. And so there's going to be a drive to have a little bit more of an anchored monetary system where the spending does not once again get out of control, like I said, the way that it has, where we're now at this point where we need to run 7% deficits, even though we have less than 4% unemployment. And, those deficits are only going to go up as, the Social Security, Medicare trust funds empty, that we're going to rein in spending a little bit with gold as an anchor.
Yes, and I think that gold as an anchor does rein in fiscal spending, which can be a good thing. But if you're in a Great Depression, it is obviously a horrible thing. I actually like the word anchor because that makes me think of ships. And okay, we just discovered this huge silver mine. So because there's a huge influx of silver, suddenly inflation should be at 20%. And nope, the ship who discovered it, it sank. So suddenly there's deflation. I mean, that just seems we're too advanced as a human civilization to be operating on those rules, in my opinion. But it's very interesting. Okay, Mel, the final pushback I have for you is okay, your argument makes sense as a qualitative argument. But as I said, when I was born in the mid 1990s, if someone, if I was thinking age then, it might have made sense to me then. What is so magical about this 120% debt to GDP ratio? Why can't we have, okay, it flatlines and then it goes to 150% and then 180%? What is so magical? And, in previous instances where the monetary floodgates burst forth and there's a breaking, 2008 great financial crisis, you say, okay, once subprime delinquencies reach 5%, then the bonds that have those in them, then they'll start to fail. And then derivatives that are composed of that, then they start to fail. And then the banking system is funded in short-term liabilities. Boom, 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 the dominoes fall. Likewise, a much, much more less dramatic crisis, less destructive crisis, the banking issues of 2023. Okay, once interest rates reach a sufficiently high level, bond losses will be severe. Okay, then specialty banks like Silicon Valley Bank, the VC, that rise in interest rates will slow the VC funding activity. All VC companies, VC-backed companies, almost by definition, lose money, or most of them, I should say. So bank deposits will fall because there's no new money being injected to VC, and then they're going to have to raise new capital. And then, okay, the dominoes fall. All that makes it into particular levels. What's so particular about the 120% debt to GDP? Or is there no particular level and you just think, okay, this is a long-term thesis and I don't know when it's going to happen, but I think it's going to happen, versus the much more specific, nope, this is it.
It's not that I have a magic number in my head that's going to hit this tipping point, and that's when we hit 138%, then it's going to go over. But what I do I look at those monthly Treasury reports, and I look at where the interest, interest on the debt. There used to be quite a number of departments and spending buckets that were higher. Now we're passing defense. Later this year, we'll probably pass Medicare. And so at a certain point where we're going to get to, let's say, 30, 40% of government spending is to fund interest on the debt. I think that is going to be kind of a light bulb going off in different investors' heads saying, hey, there's just too much Treasury supply, because we're going, it's more of a qualitative thing than a quantitative. Like at 138%, it becomes untenable. It's more of a market psychological realization that the US government is not going back to a balanced budget. They're not even going to go back to 2 or 3% deficits unless we do something. And that's when the market is going to come in and say, we demand higher yields. And then that's going to cause the politicians to do more of that, yield curve control, financial repression type stuff I've talked about. And then at a certain point, even that, doesn't work. And that's when the collapse happens.
Mel, it's been a pleasure getting a chance to hear your thesis and meeting you. I'm glad you wrote to me. I'm glad we had this conversation. Even though I pushed back, I hope you and the audience understand that it's for the sake of an interesting, debate, because it can be a little boring if everything I say is, wow, that's so interesting. It's good. It's to stimulate conversation. So tell us about your book, QUOZ, QUOZ.
It's a financial thriller. I tried to build in some of the themes that we talked about today. So it basically takes place in 2027. Quantum computing has merged with AI to actually control the stock markets. And this quantum computer called Icarus is operated out of a sub-level of the Bank for International Settlements in Basel, Switzerland. And there's essentially a bunch of hijinks, going around with central bankers from India and China and Russia, um, uh, also with corrupt U.S. politicians. There's a massive $9 trillion spending bill called the Phoenix Act that essentially triggers a financial collapse. And the hero, Rory O'Connor, who's a crypto trader in San Juan, Puerto Rico, has to kind of save the day. So if you're into thrillers and you also love finance and economics, I think it would be an interesting book. It's available wherever books are sold: Amazon, Walmart, Target, Barnes and Noble, anywhere. And it's available now. And if people want to give it a read, I think they'll enjoy it.
Definitely, I haven't read it, but it definitely sounds like the type of book that I would enjoy. Final question. You said to me earlier on our phone call that Bretton Woods didn't really start until the 1960s. The Bretton Woods Conference was in 1944, but it didn't get started until the 1960s. What did you mean?
The IMF had certain rules instituted around it for where currencies, essentially should trade. And there were wartime emergency exemptions that a lot of companies took so that they didn't have to fully, embrace the Bretton Woods IMF framework until 1961 was when different European parliaments, basically accepted these. And it was only a year later in 1962 when the British Prime Minister went to John F. Kennedy and said, "Hey, there's so much dollars right now that are being demanded. Like, you need to change that $35 an ounce to $70 an ounce because we need more dollars in the system," and so on. And Kennedy did not do that. And so it only took a couple of years of the true Bretton Woods system, the way Harry Dexter White envisioned it, being put into place before the dollar demands became almost unsustainable. And that was when the runoff started, where we went from 20,000 metric tons to 8,000 metric tons in the Federal Reserve, which eventually became untenable with Nixon's famous speech where he suspended temporarily the convertibility of gold. And of course, we've never gone back to that.
Mel, my final question for you is about Powell. When Powell seems to me to be someone who means what he's saying when he says inflation is too high, we want it to return to 2%, and we're going to raise interest rates until it returns to 2%. And definitely more hawkish than almost everyone anticipated in 2020 and 2021, probably more hawkish than he anticipated. Do you think that he is thinking about the debt to GP and, we need to inflate the debt away? Or do you think, no, he is serious? And I believe, do you agree with me that he means what he says when he says, no, we need to raise rates to cause inflation to go down to 2%, which is the exact opposite of inflating the debt away. And that it's just the forces of the world will force him or force whoever the next Fed chair will be to do that.
I believe he's a sincere person, and I believe he has the interests of Americans at heart. I don't think he's diabolical Machiavellian, central banker twirling his mustache. But I do think that he gets a little bit boxed into a corner. And I think, a lot of market participants were surprised in December when he seemingly pivoted, when the numbers didn't necessarily say, we should be talking about cuts. And that came right after that spike of 5% in October in the 10-year. And then I think in his last meeting where he talked about, hey, we're still on track, we're still, heading this way, I think he really, really, really wants to cut because he knows the rest of the world wants cuts. He knows that the world doesn't want a super strong dollar and that it causes a lot of problems. So I think as long as he can hold on to, we're anchored at 2%, he will. But at the end of the day, if you read the Federal Reserve website, there's 3 mandates listed there. It's not just unemployment and price stability. It's also long-term moderate Treasury yields. Like you can read about the Fed, what is our goal, and that if he gets into that corner where the long end starts going haywire, then he will do what is necessary to keep that in check. And that's where I think Yellen is very political and doing things blatantly to keep the yield curve in check. But I think that Powell, if the economy needs it and there's going to be a collapse or a Treasury auction is going to go bad, he will keep Treasury market stability. He will keep moderate long-term yields. and he'll do what he needs to do. And if he needs to sacrifice his 2% target, I think he will.
So you're absolutely right that the Federal Reserve has three. The third one is not talked about: moderate long-term interest rates. But you might say when nominal growth is at 5 or 6%, a 10-year bond yield of 5% is moderate. But so it's all in the eye of the beholder. But we'll leave it there. Mel, thanks so much for coming on. People can find your work at melmattison.com. And yeah, people should check out your book, QUOZ, QUOZ. Great to talk to you, Mel, and thanks everyone for watching.
Thanks, Pat.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.